Hello and welcome to your ultimate guide for the C213 OA, Accounting for Decision Makers course. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your C213 OA exam with total confidence. In this video we'll cover financial statements, accounting equation, regulatory oversight, core principles, financial ratios, and remember, our website offers free exam guides and practice questions to help you ace your C213 OA exam. You'll find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started. Let me start with what accounting really is. It's a system that gives you quantitative information, mostly financial, about businesses. The goal is helping people make economic decisions. Should you invest in this company? Should the bank loan them money? Accounting answers those questions with numbers. Now think about who needs this information. You've got investors deciding where to put their money, creditors figuring out if they'll get paid back, managers running the business day to day, the government collecting taxes, even employees wondering if their jobs are secure. They all use accounting information, but for different reasons. Before we go deeper, I want you to know something useful. I've created over 300 completely free practice questions that work directly with everything we're covering today. You'll find the link in the description. These aren't basic questions either. They test your understanding the same way your OA exam will. Bookmark that link because you'll want it later. Let's talk about the three main financial statements. First is the balance sheet. This shows what a company owns, what it owes, and what's left over for the owners. Think of it as a snapshot at one moment in time. Second is the income statement, which shows whether the company made money or lost money over a period like a month or year. Third is the statement of cash flows, tracking where cash came from and where it went. Here's what makes these statements so important. Without them, every company would report finances differently. Imagine trying to compare two businesses when one counts revenue on Tuesdays and the other counts it when customers smile. You couldn't make sense of anything. Standardized financial statements solve that problem. The balance sheet equation is simple but powerful. Assets equal liabilities plus owner's equity. Assets are resources the company controls. Liabilities are obligations the company owes. Owner's equity is what belongs to the owners after paying off debts. This equation always balances, which is why it's called a balance sheet. Let me give you an example. Say a company has $50,000 in cash, $100,000 in equipment, and $30,000 in inventory. That's $180,000 in total assets. If they owe $40,000 to suppliers and have a $60,000 loan, that's $100,000 in liabilities. Subtract liabilities from assets, and you get $80,000 in owner's equity. On your exam, you'll see questions asking you to calculate one part of this equation when given the other two. Maybe they give you total assets and liabilities, asking for equity. Or they give you equity and assets, asking for liabilities. Just remember, assets minus liabilities equals equity. Rearrange that formula depending on what you're solving for. The income statement has a different job. It measures performance over time. Start with revenue, which is money earned from selling goods or services. Subtract expenses, which are costs of running the business. What's left is net income, if positive, or net loss if negative. Revenue recognition matters here. Companies recognize revenue when they've delivered value to customers, and collection is reasonably certain, not necessarily when cash changes hands. A consultant might finish a project in December, but not get paid until January. Under accrual accounting, that revenue belongs in December. Expenses work the same way through something called the matching principle. You match expenses to the revenue they help generate. If you buy inventory in March, sell it in April, you record the cost as an expense in April when the sale happens. This gives you a more accurate picture of profitability. What we just covered appears constantly in those free practice questions I mentioned earlier. Working through them helps you see how these concepts show up in actual test format. You'll encounter scenarios where you need to determine when to recognize revenue or match expenses correctly. The practice makes these ideas stick. Cash flow statements track actual cash movement, which is different from accrual accounting. A company might show profit on the income statement, but have no cash in the bank. How? They made credit sales not yet collected, or they spent cash on equipment that gets expensed slowly over years. The cash flow statement has 3 sections. Operating activities cover day-to-day business operations, like collecting from customers and paying suppliers. Investing activities include buying or selling long-term assets like equipment or buildings. Financing activities involve getting money from or paying money to owners and creditors. Here's a key exam point. Students often confuse whether something belongs in operating, investing, or financing activities. Buying inventory for resale goes in operating. Buying a delivery truck goes in investing. Taking out a loan goes in financing. Paying interest on that loan goes in operating, but paying back the principal goes in financing. Let me walk you through an example. A company collects $300,000 from customers. That's operating activity, cash in. They buy equipment for $100,000. That's investing activity, cash out. They take a bank loan for $200,000. That's financing activity, cash in. They pay $50,000 in salaries. Operating activity, cash out. Now, who sets the rules for all this? In the United States, the Financial Accounting Standards Board, or FASB, creates generally accepted accounting principles called GAAP. These are the rules companies follow when preparing financial statements. FASB is a private organisation, not a government agency, but it has serious authority. The Securities and Exchange Commission, or SEC, oversees public companies. If your company sells stock to the public, the SEC requires you to follow GAAP and file regular reports. The SEC can investigate companies and impose penalties for violations. They want to protect investors from fraudulent or misleading financial statements. You'll also hear about the International Accounting Standards Board, or IASB. They create international financial reporting standards called IFRS, used in most countries outside the United States. The world is slowly moving toward convergence, where GAAP and IFRS become more similar, but they're still different systems today. If some of these regulatory details feel overwhelming right now, that's normal. The free practice question bank I created helps you work through scenarios involving these organizations and their roles. You'll see questions asking which body sets standards or who regulates public companies. Repetition builds familiarity. Let's talk about certified public accountants, or CPAs. These are licensed professionals who've passed a rigorous exam and met their state's requirements. CPA firms provide services like auditing financial statements, preparing tax returns, and giving business advice. When you see an audit report, a CPA signed off on it. Audits matter because they add credibility to financial statements. Management prepares the statements, but an independent CPA examines them to verify they fairly represent the company's financial position. The auditor doesn't guarantee everything is perfect, but they provide reasonable assurance that statements follow GAAP. Here's what the exam tests on this topic. You might get a question about what an audit report actually tells you. It doesn't guarantee the company is profitable or fraud-free. It says the financial statements fairly present the company's finances according to GAAP. Knowing this distinction prevents wrong answers. The difference between financial accounting and managerial accounting trips up students. Financial accounting produces statements for external users like investors and creditors. It follows GAAP and gets shared publicly. Managerial accounting generates information for internal decision-making by managers. No required format, usually kept confidential, designed for specific business decisions. Think of it this way. Financial accounting tells the story to outsiders. Did the company make money? Is it financially healthy? Managerial accounting helps insiders run the business. Should we launch this product? Which division is most profitable? Both use accounting information, but for different purposes. Bookkeeping is the record-keeping side of accounting. It's tracking transactions systematically. Accounting takes that data and turns it into meaningful reports and analysis. Bookkeeping is narrower and more mechanical. Accounting requires judgment and interpretation. Remember that understanding these fundamentals is the first step. Real mastery comes from applying them, which is where those free practice questions become valuable. They take what you're learning here and make it exam ready. The questions are designed specifically for OA success. Let me talk about some key accounting concepts you'll see everywhere. The entity concept means you keep personal finances separate from business finances. You don't mix the owner's personal bank account with the company's bank account. Each entity stands alone for accounting purposes. The going concern assumption means we assume the business will continue operating into the future unless we have evidence otherwise. This matters because we value assets as if the company will use them, not as if we're about to liquidate everything in a fire sale. The time period concept divides the ongoing life of a business into artificial time periods like months, quarters, or years. This lets us measure performance and position at regular intervals instead of waiting until the business closes to see how it did overall. Here's an exam tip for these concepts. Questions often present scenarios and ask which accounting concept applies. A question might describe mixing business and personal expenses, and you'd identify that as violating the entity concept. Or they might ask why we depreciate assets over time instead of expensing them immediately. That's because of going concern. Historical cost is another big principle. When you buy an asset, you record it at what you paid for it. That's historical cost. It's reliable because you have objective evidence of the transaction. The alternative would be recording assets at current market value, which requires estimation and judgment. Assets lose value over time through use and age. We call this depreciation. Instead of expensing the full cost when you buy equipment, you spread that cost over the years you'll use it. This matches expense to the periods benefiting from the asset, which ties back to the matching principle we discussed earlier. Let me give you a practical example. Buy a delivery truck for $40,000. You expect to use it for 5 years. Each year you'd record $8,000 in depreciation expense. After 3 years you've recorded $24,000 in depreciation. The remaining $16,000 is called book value, the original cost minus accumulated depreciation. Accumulated depreciation is an important concept for your exam. It's not cash sitting somewhere. It's the total depreciation recorded on an asset since purchase. You'll see it on the balance sheet as a subtraction from the asset's original cost. This shows both what you paid and how much useful life you've consumed. Materiality is a judgment call in accounting. Information is material if omitting it or misstating it could influence decisions. $1 million error matters to any company. A $100 error might not matter to a $1 billion company, but would matter to a small business. Consistency means once you choose an accounting method, you keep using it. If you decide to depreciate equipment using straight-line depreciation, you don't switch to a different method next year without good reason. This makes financial statements comparable across years. As we move through this material, remember that practice makes perfect. Those free practice questions I mentioned help you take this knowledge and transform it into test-taking skills. You learn to recognize how questions frame these concepts and what answers examiners want to see. Comparability lets users analyze one company against another or track one company over time. When all companies follow GAAP, their statements are somewhat comparable. Without standards, comparison would be impossible because everyone would report differently. Relevance means information is useful for making decisions. It's timely and helps predict future outcomes or confirm past results. Reliability means you can depend on the information being accurate and unbiased. There's tension between these two. More relevant information might be less reliable because it involves more estimation. Conservatism says when in doubt, recognize losses but not gains. If an asset might have declined in value, record the loss. If an asset might have increased in value, wait for proof before recording a gain. This prevents overstating financial position. The Sarbanes-Oxley Act came after accounting scandals in the early 2000s. It increased regulations on public companies and their auditors. Company executives must personally certify that financial statements are accurate. Auditors face more oversight. The goal was restoring investor confidence after fraud at companies like Enron and WorldCom. The Public Company Accounting Oversight Board, or PCAOB, was created by Sarbanes-Oxley. This board oversees auditors of public companies. They register audit firms, set auditing standards, inspect audits, and can discipline auditors for violations. Before this, the accounting profession largely regulated itself. Here's how this appears on exams. You might see questions about what Sarbanes-Oxley requires or what the PCAOB does. Common wrong answers confuse the PCAOB with the SEC or FASB. Remember, PCAOB oversees auditors specifically, not all aspects of financial reporting. Technology has transformed accounting. When accounting emerged, everything was manual. People recorded transactions by hand in ledgers. Computers changed everything. Now accounting software automates bookkeeping, generates reports instantly, and handles complexity that would overwhelm manual systems. But the principles stay the same. Whether recording transactions with quill and ink or sophisticated software, you're still applying the same accounting concepts. Debits and credits work the same way. The balance sheet equation still balances. Technology changes how fast we process information, not the fundamental logic. Globalization matters too. Companies operate across borders. Investors buy stock in foreign companies. This created pressure for international accounting standards. That's why IFRS exists and why there's movement toward convergence with GAAP. The world economy functions better with compatible accounting languages. On your exam, expect questions about the difference between FASB and ISB. FASB sets US standards, GAAP. ISB sets international standards, IFRS. Most countries use IFRS. The US uses GAAP. They're working toward alignment, but aren't identical yet. Ethics matter deeply in accounting. Accountants handle sensitive financial information and make judgments that affect how companies appear to outsiders. The profession has codes of ethics requiring integrity, objectivity, and professional competence. CPAs can lose their licenses for ethical violations. Notes to financial statements provide additional detail that won't fit in the statements themselves. They explain accounting policies, give breakdowns of summary numbers, and disclose important information not captured in the formal statements. Reading the notes is part of analysing financial statements properly. Your exam will ask about what belongs in notes versus what appears in statements. Significant accounting policies go in notes. Detailed breakdowns of inventory categories might go in notes. The summary inventory number goes on the balance sheet. Both pieces work together to tell the complete story. Earnings per share, or EPS, shows up constantly in finance. It's net income divided by number of shares outstanding. If a company earns $10 million and has 5 million shares, EPS is $2 per share. Investors watch this number closely to gauge profitability. The price-earnings ratio, or PE ratio, compares stock price to earnings per share. If a stock trades at $40 and EPS is $2, the PE ratio is 20. This tells you investors are paying $20 for every dollar of annual earnings. High PE ratios might signal growth expectations or overvaluation. Here's the thing about these ratios. You don't just calculate them, you interpret them. A PE ratio of 10 might be low for a tech company, but high for a utility. Context matters, industry matters, trends matter. Your exam questions will test whether you understand what numbers mean, not just how to compute them. Let's review everything we've covered so you're ready for your exam. Accounting is a system providing financial information for economic decisions. The three main statements are the balance sheet, income statement, and cash flow statement. The balance sheet shows financial position at a point in time. The income statement shows performance over a period. Cash flows track cash movement. FASB sets US accounting standards called GAAP. The SEC regulates public companies and requires GAAP compliance. The ISB sets international standards called IFRS. CPAs are licensed professionals who can audit financial statements and provide accounting services. An audit gives reasonable assurance that statements fairly present financial position. Key concepts include the entity concept, keeping business separate from personal. Going concern, assuming the business continues operating. Historical cost, recording assets at purchase price. Matching, aligning expenses with related revenues. Materiality, focusing on information that matters. Consistency, using the same methods over time. Managerial accounting serves internal decision-making and stays confidential. Financial accounting serves external users and follows GAAP. Both use accounting information, but for different audiences and purposes. Technology has accelerated accounting, but fundamental principles remain unchanged. Don't forget to grab those free practice questions from the link in the description. With the knowledge you've gained today, plus practice from those questions, you'll walk into your exam well prepared. These concepts form the foundation for everything else in accounting, so getting them solid now pays dividends later. You've now got the core knowledge you need for the Accounting Fundamentals portion of your C213 exam. The concepts we covered appear throughout the test in various forms: revenue recognition, the balance sheet equation, financial statement purposes, regulatory bodies and their roles. Practice applying these ideas until they feel automatic. Remember that exam success comes from understanding concepts deeply, not just memorizing definitions. When you can explain why the balance sheet equation works, or why we use accrual accounting instead of cash accounting, you're ready. The practice questions help you build that deep understanding. Good luck on your exam. You've put in the work to learn this material. Now practice applying it and you'll do great.